Good afternoon. We are happy to be here today to provide an overview of the bank capital rulemaking proposals. In March of 2026, the Office of the Comptroller of the Currency, or the OCC, the Federal Reserve, and the Federal Deposit Insurance Corporation, or the FDIC, approved two notices of proposed rulemaking that would modify the regulatory capital requirements for all banking organizations. Given that we are here at the CFTC today, we're going to focus most of our discussion around the proposed changes to the capital requirements for derivative transactions. Now, these two notices of proposed rulemaking include, one, it's a proposal that modifies the capital requirements designed for the largest and most complex banking organizations. This proposal, it's commonly referred to as the Basel III proposal, sometimes the expanded risk-based or ERBA proposal. This proposal is largely based on the 2017 Basel Agreement, with changes tailored to the U.S. economy and banking industry, as well as lessons learned from the 2023 proposal. And for context, this 2017 Basel Agreement refers to a capital framework that international regulators, including U.S. banking regulators, worked on together to set a minimum framework for internationally active banking organizations. The U.S. banking regulators issued a proposal in 2023 that closely followed this agreement. That 2023 proposal was not finalized, but feedback received did inform the recent 2026 proposals. This Basel III proposal would also be optional for all other banking organizations to elect. And the second proposal was designed to modify the capital requirements for all other banking organizations. And this proposal is generally referred to as the standardized approach proposal. And the modifications made in this rulemaking were intended to better align with the recalibrated capital requirements in the Basel III proposal while still remaining a simpler framework. Now, the public comment period on both of these proposals closed on June 18, 2026. And the interagency proposals received over 400 comments that the agencies are in process of considering. And at a high level, what these proposals do, they would work together to improve the regulatory capital framework by better aligning capital with risk and simplifying the framework where possible. So for example, under the current framework, the largest banking organizations are required to calculate their capital requirements twice, once under a standardized approach, and then again under an internal models-based approach. The banking organization would then hold a higher amount of capital. Under the capital proposals, this dual calculation requirement was proposed to be removed so that the largest banks would only have one minimum capital requirement to calculate. Consistent with the objectives I mentioned above related to enhanced risk sensitivity and simplicity, the proposals seek comment on a broad range of changes to the regulatory capital framework for banking organizations. But again, as I said before, for purposes of today's overview, we're going to focus on the key changes made to the capital requirements for derivatives, as we believe that is most relevant for you all here. And as we describe the relevant policies being considered in the 2026 proposal, we will also draw comparisons to the 2023 proposal where appropriate. And these changes that I described today also apply to both proposals. So for derivative transactions, a banking organization's capital requirements generally include market risk, counterparty credit risk, and changes in the value of counterparty credit risk, which is also known as credit valuation adjustment or CVA risk. With respect to market risk, as compared to the 2023 proposal, the 2026 proposal reduces barriers for banking organizations to be able to use their risk-sensitive internal models to determine their market risk capital requirements. Although consistent with today, use of internal models would require regulatory approval. The 2026 proposal also raised the activity-based thresholds at which a banking organization would be required to use the market risk framework, as well as the CVA framework. For counterparty credit risk, the 2026 proposal would allow large banking organizations to recognize the risk-reducing benefits of qualifying cross-product netting arrangements for derivative transactions and certain repo-style transactions. And this is an example of improved risk sensitivity that was not included in the 2023 proposal. For CVA risk, the 2023 proposal required a CVA capital charge for client-facing derivative transactions for cleared trades, which was consistent actually with the Basel Agreement. This requirement, however, was criticized as it was inconsistent with CVA risk in the accounting treatment of such transactions. So in other words, The 2023 proposal would have required a capital charge for CVA, even though for accounting purposes, the banks would not have to calculate such a P&L amount for this group of derivative exposures. So the 2026 proposal instead would remove the capital requirement for CVA risk for client-facing derivative transactions for cleared trades. This policy change should serve to support banking organizations serving their clients in a bank's role as a clearing member. Relatedly, I'd also like to highlight an existing feature of the capital rule, which includes a lower risk multiplier for commercial end users, which should include many of the stakeholders here today. So the proposed implementation of the CVA risk framework would build on this existing policy to support banking organizations, again, in their role as clearing members. And finally, as I mentioned at the beginning of my remarks, the two rulemakings are in the proposal stage. And as part of the proposals, the agencies included a number of questions to solicit feedback from the public to help prudently achieve risk sensitivity in the bank capital framework, including for clearing-related activities and transactions with non-financial counterparties, which should be of interest to many here today. So that concludes my remarks. Thank you again for having us.